Hello everyone, welcome to video number 6 on being an option seller. Let's just go over disclaimers. Trading securities, options, futures can involve risk and the loss of funds. Options and futures trading is generally considered more complex than stock trading. The securities, options, futures used as examples are used for illustrative purposes only. We are not recommending that you buy or sell these securities, options, futures. Past performance shown in examples may not be indicative of future performance, and no part of this may be copied, recorded, or rebroadcast without any prior written consent. So, in a previous session, we talked about being an options buyer. So, remember, there are two types of options there are calls and there are puts. And you can be the buyer of a call or a put, which is what we discussed in a previous session, or you can actually be the seller of a call or a put. Now, remember, as a buyer of a call, you would like price to go up, which is why if you're thinking of buying a call option, you really prefer to look for stocks that are uptrending. Why? Because there is a higher probability for price to go up, which means there's a higher probability for you to actually make some money. When you buy a put, you would like price to go down, which is why we would prefer, if we were to buy a put, we would prefer for price for the trend to be downtrending. Why? Because then there is a higher probability that price will continue down, which means that there is a higher probability for us to actually make money if we were to buy a put. Now, a long call, and remember, a fancy way of saying you entered the position as a buyer would be long. So a long call is essentially buying a call. So a long call gives the owner the right to buy a stock. In other words, if you buy a call, you are buying the right to buy a stock. A long put, which means you're entering the position as a buyer. In other words, you are buying a put. A long put gives the owner the right to sell a stock. So a long put essentially gives you the right to sell a stock. Now, remember, this is entering a position as a buyer of a call or a buyer of a put. We are actually going to switch, and we're actually now going to be the seller of an option. In other words, we are entering a position as a seller. So when we use the term short, short just means you are entering a position as a seller. So when we sell a call or when we sell a put, we can say that we have a short call or we can say we have a short put. Now, everything has an equal and opposite. So a short call will give someone else the right to buy your stock. So when you sell a call, you are giving someone else the right to buy your stock. And since everything has an equal and opposite, remember, if you buy a call, you want price to go up. Everything has an equal and opposite. So if you sell a call to enter a position, if you sell a call, you would actually like price to pull back or go down when you sell a call. Everything has an equal and opposite. So when you buy a put, you would like price to go down. So everything has an equal and opposite. So if you sell a put to enter a position, if you sell a put, you are giving someone else the right to put the stock to you. In other words, you are giving someone else the right to sell the stock to you or make you buy the stock put. Now remember, when you sell a put, you are selling to someone the right to make you buy the stock or put the stock to you. When you sell a put, you want price to go up in order to make money. In other words, if price goes up, that is better for you because selling a put is a strategy that's designed to make money when price goes up. Well, if we would like to make money when price goes up, we would like to pick a bullish trend. In other words, bullish just means we want price to go up. So we pick a bullish trend, which means we would like an uptrending stock. If we would like an uptrending stock and we're looking at a stock fundamentally speaking, then we probably want a stock that has good fundamentals, that is a strong company, because that just puts more odds in our favor. In other words, that can increase the probability of our success. So we want to find a stock to trade that's heading up. Now remember, if you're selling a put, you are selling the right for someone to make you buy the stock, potentially make you buy the stock. So if you're going to sell a put, make sure that you sell a put on a stock that you would not mind owning anyway. In other words, you're going to buy the stock anyway. So if you sell a put, then make sure that you use the same criteria that you would normally use to buy a stock. Normally, when we are the seller, we want to be obligated for less time than buying and holding for the long run. So typically we look at a time frame anywhere between 20 to 40 days out. That's usually a pretty reasonable guideline. When we pick a strike price, we'll go over that in just a few minutes. We want to place our order and then we can wait for assignment. Now, when you sell a put, you can either be assigned the stock, which means you would have to buy that stock. So remember, when you sell a put, you are selling the right for someone to make you buy the stock. So you could either be assigned that stock, which means you would have to buy that stock at the strike that you sell the put at, or you may not be assigned the stock at all. So when you sell a put, remember you're the seller, which means when you sell something, you collect money. So if you were to sell let's say, book to me, and let's say you sell the book to me for $10, you would collect $10 for selling the book. When you sell a put option, you would actually collect premium when you sell to open the put option. So that's what we're doing initially is we're collecting premium initially, whether we own the stock or not. We're collecting premium initially. Now, why would the brokerage firm allow you to actually sell a put if you don't even own the stock? Well, as long as you have enough money to buy the stock in case the stock is put to you, then the brokerage firm has no problems with you selling a put even if you don't own the stock. As long as you can buy the stock in case you are put the stock, then you can definitely do this particular strategy. So of course, when we pick out a trend, we want an uptrend. Now you can sell a put on a market index, you can sell a put on an ETF or exchange traded fund, which is a stock. Oftentimes someone might look at maybe a broad market ETF, such as the SPY, which tracks the S&P 500, or the QQQ, which tracks the NASDAQ 100. So you can certainly do it on something like that. You can pick just a good quality stock that you like. So you can use the good stock search. You can use the undervalued stock search. You can use the almost good stock search. Any of those searches that will find you a good fundamentally sound stock that you wouldn't mind owning anyway. And then of course you want to make sure that that stock is still going up. So the fundamental analysis of the stock first, and then the technical analysis to make sure that the stock is actually heading up in terms of price action, because you still want to be able to make money. And remember, we're looking at 20 to 40 days out. So we're not looking at long-term investing here. We're just looking at a shorter term time period where we can collect some premium and perhaps pay a monthly bill and then move on. So when you're looking at selling a put, remember again, you would like to find a stock that you would not mind owning anyway. So you're not just looking for any stock, even if you're looking, let's say you look for a stock because it has a good rate of return potentially. But what if that stock is not even going up? What if the stock is downtrending? Well, then that's not a very good setup for you. When we check the chart, we want an uptrending stock. We'll take a look at maybe which strike we're going to select, and then of course some of the technical indicators to support a bullish strategy, which is what selling a put is. It's a bullish strategy. So let's take a look at a chart. So we mentioned that we would prefer an uptrending stock. Why? Because we want to make money as price goes up. And if for some reason we are put the stock or we have to buy the stock, then we would prefer stock that is going up, correct? So currently, TSM is at $32.81. Now, when we sell a put, we would actually typically prefer to sell a put that's underneath the current strike price. Why? Because we would prefer to sell a put where if we are put the stock or made to buy the stock, we are put the stock at a lower price or a discounted price from the current stock price. In other words, if we're going to buy stock, we would typically pay $32.81, which is the current going price. So if we're selling a put, we would prefer someone to pay us money to buy the stock at a discounted price. So how does this work? Well, because you're the seller, and remember this is puts, so calls are on the left-hand side, puts are on the right-hand side. So let's say that we choose to sell the $32 put. Now remember, as the seller, you look at the bid price because the bid price represents the current going price for if you were to sell something. Ask is the current going price if you were to buy something. So again, buy at the ask, sell at the bid, buy at the ask, sell at the bid. If you're selling a put, you would take a look at the current bid price. Now the current bid price is at 35 cents. Notice that the current ask price is at 50 cents. So there is a bit of a spread, more than 10 cents, between the bid and the ask. Now, if the market is open and you're taking a look at this particular option chain and you see that the bid price is going for 35 cents and you place an order to sell this put at 35 cents during the day, and that's the going price, you will be filled immediately. Now, if you have a spread that's more than 10 cents, you can always choose. So remember, trading is a decision-making process. You are the one who makes those choices. So you can always choose to see if you can get a little bit of a better price for yourself. So typically Mike will say go in between the bid and the ask price if you're looking to get a better price for yourself, and then maybe give the market maker a little bit more. So if we go in between the bid and the ask and give the market maker a little bit more, then we might take a look at maybe seeing if we can sell the put for about 40 cents. So that means if we give the market maker a little bit more, that means we collect a little bit less than the midpoint between the bid and the ask, and then we can perhaps potentially get a little bit of a better price for ourselves. Now, it doesn't mean we're guaranteed to be filled if we go in between the spread between the bid and the ask, but there's a chance that we could be filled. So we can always choose to do something like that if we would like. Now, in this case, we are taking a look at just selling at the bid price. So this is how you would place your order. So you would type in the ticker symbol, you would select the expiration date, so anywhere between 20 to 40 days out, the strike price that you want to sell at. So remember, the strike is the agreed upon price. You choose the strike price. And then, of course, we're looking at selling to open. So selling to open the position, we're selling to open the put option. You can choose how many contracts you want to place the order at. So remember, one option contract controls 100 shares. So in this case, if we're looking at selling 5 contracts of the 32 puts, then that means that we're controlling 500 shares. Now we specify the price, which is why we select limit order, not market order. Market order just means, hey, market, fill me at any price you want to fill me at. So it's kind of like giving the market a blank check if you were to select market order. But limit order means we specify the price that we are willing to get filled at, have our order filled at. So in this case, 35 cents. So remember, one contract controls 100 shares. So if we are selling the 32 put at 35 cents, that means for one contract we would collect, to do this trade, we would collect $35. So this is 35 cents per share times 100, so that would be $35 for 100 shares or one contract. In this case, we're looking at 5 contracts, so that would be 500 shares, so that would be $35 times 5 contracts. So that would then be $175 that we would collect by selling the 32 put for 5 contracts. So let's just go back and let's talk about what this really means. So remember, the stock is currently going for $32.81. We sell a lower strike put, which means we sell the 32 put, which is lower than $32.81. When we sell the put, we collect 35 cents. So what does this mean? Well, when we sell the put, we are selling the right for someone to make us buy the stock or put the stock to us at $32. Right now, the stock is at $32.81. So let's say that on expiration, the stock closes at, let's say, $33. Now, remember, we sold the $32 put. So 32 is right here, and we sold the $32 put. Now, on expiration, if the stock is at $33, will someone make us buy the stock at $32 if the stock is currently going for $33? What do you think? You are exactly right. No one will make you buy the stock at $32 if the stock is currently going for $33. Why? Because they can actually make someone else buy the stock on the open market at $33 for a more expensive price, which means they would make more money than if they were to make you buy the stock at $32. So this option that you sell, the $32 option, the $32 put that you sell at, in this case, 35 cents, becomes worthless in value. Why? Because it's not worth anyone on expiration date. No one's going to make you buy the stock at 32. So this option becomes worthless, which means that that 35 cents that you initially collected to place that trade or enter the trade actually becomes worth zero. Why? Because the option is worthless on expiration date, because no one will exercise their right to make you buy the stock at 32 because they can make someone else buy the stock at $33. This is what we want to see as a seller. As a seller, you collect money up front, which means once you collect that money, that's the most that you can make. So if we collect 35 cents, that's the most that we can make per share as soon as we enter the trade or sell to open the put. So how do we make money as a seller? Well, we would like this value, this option premium, to actually decrease so that if we were to exit the put that we sold, in other words, we were to buy to close. So when we entered the trade, we sold to open. So if we were to exit the trade prior to expiration, we would buy to close. Now, we would prefer to buy to close at a cheaper price. So it's the same as when you sold the book at $10 to me. Let's say you sold the book at $10. Well, let's say that you want to buy back the book. Well, you would prefer to buy back the book at a cheaper price. So let's say that the book got torn up and everything like that, and now the book is only worth, let's say, $3. Well, you would prefer to buy back the book at its current value. So you originally sold the book at $10. Now it's only worth $3. You buy it back at $3. You now keep the profit difference of $7. That's how you make money as a seller. It's the same thing in the market. When you sell something and you want to exit that trade or close out that trade prior to expiration, you would prefer to buy to close at a cheaper price. So let's say that the option decreases in value and it goes down to, let's say, 10 cents. Well, now you could buy to close that option at 10 cents and keep the 25-cent profit difference. The ideal scenario is if it just goes down to zero, where the option isn't worth anything and then there's nothing to buy back. The option expires worthless. You keep all of the 35 cents that you collected initially, and then your trade is done. You can then sell a put for the next month out and collect that money. Now, if the stock is at $33, you sold the $32 put, no one makes you buy the stock at $32. You keep all of the premium that you initially collected. You never have to buy the stock. You move on to the next trade. What you're doing is you just sold an option without having to own the stock. You collect the premium. You move on to the next trade. So this is where you can actually start to sell a put every single month and not even have to own the stock. How do you do that? Well, number one, you look for a stock that's uptrending. Number two, we typically want to place our strike, the put that we sell, lower than the current stock price. Why? Because then what you're doing is if we sell the put at $32, we collect 35 cents. So what are we doing? Well, we are having someone pay us money to buy the stock at a cheaper price than what it's currently going for. So let me get this straight. We're having someone pay us premium, pay us money to buy the stock at a discounted price from what it's currently worth, what it's currently going for. I like that. Now, since we're selling a lower strike, that means that as long as the stock stays above the strike that we sell, in this case 32, as long as the stock stays above 32, no one will make us buy the stock and we get to keep the premium. We don't have to buy the stock. We can move on to the next trade, which means in this scenario, the stock can go up. And that's what we want it to do. We actually want the stock to go up. Why? Because if the value of a stock goes up, the value of a put option actually goes down. So if we sold the put at 35 cents and the stock actually goes up from $32.81, the value of the put will actually start to drop or decrease in value, which means the higher the stock goes up, the less this premium is now worth, which means we can actually potentially buy back the premium at a cheaper price. Now, if it goes up and up and up and time passes, so remember, as a seller of options, time value actually works in our favor. In other words, time value decays the closer it gets to expiration. Well, that's great for us because we want this premium that we initially collected to start to decrease in value the closer it gets to expiration. And it will decrease in value by two things. It will decrease, number one, if the value of the stock goes up because the value of puts will actually decrease. And number two, if the time value decays the closer it gets to expiration, that will also help the value of our option premium to actually decrease as well until it's worth zero on expiration date, which is what would be ideal. But if the stock doesn't go up, which is what we want it to do, because remember, this is a bullish strategy, if the stock doesn't go up, at the very least, it just does nothing and stays at $32.81. As long as the stock stays above 32, we will still make that 35 cents per share premium or $35 for one contract premium. If the stock goes down just a little bit, now we don't want it to go down, but if it does go down, if it can at least stay above 32, we will still make that 35 cents a share premium. So what's happening now is the stock can go up, sideways, or even down a little bit, and we still have a chance of making that 35 cents a share premium. So that's what we call a higher probability of success type of a trade. So if we were to be the buyer of an option, so what's the equivalent bullish strategy of being, but instead of being the seller, which is what we're doing right now, we're the buyer. Well, if this is a bullish strategy and we're the buyer, we would do something like perhaps buy a call option. So if you buy a call, you are buying the right to buy the stock, which means you want price to go up. If you sell a put, you are selling the right for someone else to make you buy the stock, which means that you would like price to go up. So notice that both of those strategies, whether you're the buyer or you're the seller, you still want price to actually go up. However, if you are the buyer, of a call option, price has to go up for you to make money. Not only does it have to go up, but it has to go up more and faster than the time value decays on the option, which means if you buy a call, you need price to make up in order you need price to go up in order to make money. It has to go up. In other words, you have to be pretty much perfect in your direction and the amount the stock actually moves for you to make money when you buy a call option. And not only that, when you're the buyer of an option, time value is actually working against your option. If you're the seller, in this case, you're still bullish, but now you want to be the seller, so you sell a put. You actually don't have to be perfect in your direction. You want it to go up. That's what it's designed to do, is you want price to go up. But if it doesn't go up and it now goes sideways or even a little bit down, depending on how you structure your trade. In other words, depending on where you sell your put, you have a chance of making money even if price actually fluctuates between now and expiration. So that's the advantage of being the seller is you actually don't have to be perfect. You are essentially giving yourself a little bit of cushion to be able to make money. And when you give yourself a little bit of cushion to be able to make money, you are increasing your probabilities of success. Now, if you are assigned the stock, in other words, let's say that you do sell the $32 put, and let's say on expiration the stock closes at $31.89. Will someone exercise their right to make you buy the stock at $32 on expiration if it's now currently worth $31.89? You got it. They will absolutely exercise their right to make you buy the stock at 32. Why? Because they can make you buy it at a higher price than what it's going for on the open market. They then, because you sold to them the right, they exercise their right to make you buy the stock at $32, which means you will now own the stock at $32. Once you own the stock at $32, so again, why would the brokerage firm initially allow you to sell something that you don't even own? Because they, as long as you have enough money to buy the stock at the strike that you sold in your account, they will allow you to sell the put even though you don't own the stock. So now on expiration, the stock's worth $31.89. Someone will exercise their right to make you buy the stock at 32. You will now be assigned the stock at 32, which means you will now have to buy the stock at 32. But you're okay with that because you were paid money to buy the stock cheaper than what you would have bought it for anyway. All right, so now you're assigned the stock at 32. Once you own the stock, you now own the stock. So what could you do? What could you do next? Well, you could either just sell the stock if you would like. If you want to just completely get out of the stock, you could sell the stock. You could wait for the stock to go a little bit higher and then choose to sell the stock. Especially if it's an uptrending stock, you might choose to wait for it to go higher and then choose to exit the stock, sell that stock, lock in some profit. Now remember, if you're assigned to the stock, you still get to keep that premium that you initially collected. Once you collect that premium, then that money goes into your account and now you just own the stock. So let's say you own the stock. Well, what could you do next? Exactly. You could actually, quote, rent out your stock by selling a call option now on your stock and turn this strategy, the stock that you own, into a covered call strategy. In other words, you can, once you own the stock, you can now start to, quote, rent out your stock every single month, collect some extra premium on the stock that you own anyway. So there are a lot of choices when you start to introduce options into your skill set. So covered calls is a two-part strategy. It's a stock strategy and an option strategy combined. So step one for when you do a covered call is number one, you either buy a stock or you already own a stock. So you buy a stock or you already own a stock. So many of you, or you could even buy an ETF, an exchange traded fund. So many of you have owned stock for years, or you've owned stock for maybe a year or longer, or multiple years, or you've owned stock for the last 10 years, all right? So this is a strategy that you could have been doing all this time. So step one, you buy a stock, or you already own a stock or an exchange traded fund. Step two, you, quote, rent out that stock by selling a call option. So think of it this way. So let's say you own investment property. Now, hopefully that investment property is appreciating in value. It's appreciating in value, all right? Now, while it's appreciating in value, you probably wouldn't let that investment property just sit there empty. You would probably do what? Exactly. You would probably rent out that investment property to collect additional cash flow while you're owning that property at the same time. Now, let's say that that property is not appreciating in value at all. Let's just say it's not doing anything. Let's just say it's going sideways. Well, you probably would still rent out that investment property and at the very least make some money by renting it out, collecting that extra income every single month. It's the same thing with your stock. If you're going to own stock anyway, hopefully your stock is appreciating in value. And while it's appreciating in value, you might choose to, quote, rent out that stock by collecting some premium every single month on that stock that you would own anyway. And if the stock is actually going sideways, let's say it's doing nothing, how would you make money on a stock that's going sideways? Well, you could, quote, rent out that stock by selling a call option every single month on a stock that's going sideways anyway. Because on a stock that's going sideways, you're not making money, but you could sell a call option every month on that stock and start to actually bring some income every single month on the stock that you would own anyway. So you buy a stock, step one, or you already own the stock. Step two, you sell a call option. When you're the seller, you collect premium into your account. Now, what does it mean when you sell a call option? You are selling the right for someone to buy that stock from you. You are selling the right for someone to buy that stock from you. So let's say you sell a $30 call option. Well, you are selling the right for someone to buy the stock from you at $30. When you sell that right, you collect premium for that right. So you could actually do this every single month. And again, as a seller, you're really looking to sell the call option anywhere from 20 to 40 days out. That's what you're really looking to do. You're not looking to sell your call option 6 months out, because then you're under obligation for quite a bit of time. You might as well sell that call option every single month instead of for 6 months, versus just selling a call option 6 months out. So again, 20 to 40 days out. That's a nice guideline as a seller. Now, what is our goal? Well, we want to bring in some additional cash flow from stocks that we already own. And if the stock does start to pull back, it will actually help to offset a little bit of perhaps the pullback in the stock value itself. So, for instance, let's say that you own a stock that's uptrending in value. All right. So it's doing something like this. And we know that when stocks go in an uptrend, all right, we know that the stock has to be able to take a breath. So that's why an uptrend is made up of higher highs and higher lows. So price has to be able to fluctuate within the uptrend as long as the uptrend stays intact, which means higher highs and higher lows. So you're making money if you buy stock over here. You're making money as long as the stock goes up, with the understanding that price is going to fluctuate within that uptrend. Now, if the stock goes up, that means the value of your stock is going to increase, correct? As the stock takes a breath, then the value of the stock is going to pull back temporarily. If it pulls back to a higher low and then bounces to a higher high, and then the highs keep getting higher and the lows keep getting higher, then the value of your stock is just increasing. All right. And the trend hasn't changed. It's still uptrending, but it's just increasing, with the understanding that price is going to fluctuate within that uptrend. When it pulls back or takes that breath, that would be the perfect time to sell the call. Why? Because when the value of a stock goes up, the value of a call option also goes up. When the value of a stock goes down, the value of the call option will actually decrease. So let's say that the value of the stock is going up and it goes up, 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 up. It hits a high, or what we call a resistance area. So any high point on a chart is resistance. So it hits a high. Let's say that the value of the call is now worth $1. It hits a high, just starts to roll over. All right. This would be the perfect time to sell the call option when it hits a high and starts to roll over. Why don't we sell the call at the high? Because we don't know if it's going to go any higher. If it goes higher, then that means our call option will be worth even more. But if it hits its head on resistance and starts to roll over, then you can potentially sell that call option when it's worth the most. All right. So it hits its high. Let's say resistance is right here. It's worth $1. Starts to roll over. Maybe now the call option is worth about 95 cents. You sell the call option at 95 cents or $95 for one contract. And then as the stock pulls back, then the value of this call option is going to start to decrease. Let's say it decreases to, let's say, about 45 cents. All right. Now, it hits a low, a higher low. In this case, it hits a higher low, or what we call support. And you can actually potentially buy back the call that you sold. So up here, you sold to open. You can now buy to close the call option if you would like prior to expiration. You can buy to close the call option when it hits support because the call option is now worth less in value. You can buy to close. You can lock in that profit. So in this case, you would lock in about 55 cents or $55 for one contract. And as the stock starts to bounce again, then you no longer have the call option because you locked in your profit. Now the stock can go up in value, hit a higher high now, and you can then turn around and sell another call option when it hits the resistance and starts to roll over. And at the same time, maybe the Colville indicator starting to roll over, the MACD starting to roll over. So this is a way that you can use technical analysis as your edge to maximize your profit even more. So if you choose to do something like this, where you buy the stock first and then you wait until the value of the stock goes up, hits its head on resistance, starts to roll over, and then you choose to sell the call when the call option is worth the most, that's called legging into your covered call strategy. In other words, doing one step at a time. So you could buy the stock and sell the call all at the same time, or you can actually buy the stock first, let the stock go up in value, let it go up to a higher resistance area. When it starts to roll over, then sell a call option. So it's almost like doing one leg at a time, which is why we call it legging in. Legging in. So this is a great way to profit as the stock is going up, and then also profit when the stock is taking a breath or fluctuating within the uptrend. Now, can you do covered calls on mutual funds? You cannot do covered calls on mutual funds because mutual funds are not optionable. However, exchange traded funds, which are essentially mutual funds that trade as a stock, so an ETF, which is exchange traded fund, is a stock. Because it is a stock, many ETFs are optionable, which means that you could actually sell calls off of those ETFs and actually collect some extra premium or additional cash flow. So exchange traded funds are diversified just like mutual funds. They track similar things like mutual funds do. So for instance, if you have an exchange traded fund that tracks the S&P 500, which is the SPY, you can write a covered call on the SPY. If you have an exchange traded fund that tracks the technology sector, the financial sector, maybe the NASDAQ 100, you could be writing covered calls on those exchange traded funds. In addition, you can actually collect dividends on exchange traded funds every single quarter. So lots of choices here when you start looking at stocks or ETFs that are optionable. So that's why many investors will or traders might choose to convert their mutual funds to ETFs that track the same thing that the mutual funds do, except now you can actually start to write covered calls on those exchange traded funds, which you cannot do with mutual funds. All right. And again, use your technical analysis to support your buying the stock and selling the call option. Don't just look for a high rate of return. Look for a stock that you have good reasons to own anyway. Because again, you want those stocks to go up in value, and then look at renting out those stocks or selling the call option off of those stocks you would own anyway. Now, this can be used as protection. So again, if the stock pulls back, that's a great time to sell the call option because that can help offset some of the temporary pullback. Also, if you want to hold a stock over earnings, and earnings happens 4 times a year quarterly. So sometimes over earnings, earnings can be quite unpredictable. Well, if you want to own the stock anyway over earnings, then you might choose, or some traders might choose to sell a call option during that earnings time just to protect themselves a little bit. And especially if the stock actually goes down over earnings, then you're still making some money on that call option that you sold. And then, of course, if you start to collect premium off of the stock that you own anyway every single month, that additional income that you make off of the stock every single month can be utilized to purchase new stocks and add to your portfolio. So how do you know which call option to sell when you do a covered call? So again, we want to find good quality stocks. We want to use our technical analysis as our edge in terms of maximizing our potential profit. And then we want to sell a call. Now, when we sell a call, how do you pick which strike to sell? So typically, when you sell a call, you always ask yourself, Would I rather sell my stock at a higher price or lower price? That's how you choose which strike to sell. Now, again, we're combining stocks and options together as one strategy. So remember, one contract controls 100 shares. So when you choose your stocks, and again, you want to make sure those are optionable. When you choose your stocks, you want to be able to buy at least 100 shares of stock to then be able to sell at least one contract or one call option. Now, can these covered calls be done in your self-directed IRAs? Absolutely, they can be done in your self-directed IRAs. So let's take a look. So if you buy a stock, so let's actually go live to the website. So let's just go to SQ since we have that pulled up. Now remember, the stock is currently at $18.24. So when you're looking to sell a call option on a stock that you own, you always ask yourself, would I rather sell my stock at a higher price or a lower price? And typically the answer is you would rather sell your stock at a higher price. So if we're looking at this, we can choose to sell a call option at $19. That's considered out of the money call. So remember, calls are on the left. So we can choose to sell an out of the money call option. So the $19 call, that's out of the money. We can choose to sell an even further out of the money. We could even sell the $20 call option and we would collect premium there. Now, the higher you go, the less premium you collect. But the higher you go, the less likely you will be called out of your stock. And if you are called out of your stock, you actually make even more money on the stock value itself, in addition to the premium that you collect for selling the call option. So there are trade-offs, right? So it's completely up to you how high you want to go. If you don't want any possibility of selling your stock at all, then you probably don't want to do a covered call. So for instance, a covered call strategy is ideal for stocks that are going slightly up like this, or stocks that are actually going sideways. All right, those are really good candidates for covered calls. If the stock is just doing this, then you might want to hold off on doing a covered call because you want to allow the stock to really just take off in value. So if you have a stock that's just shooting to the moon, then you might want to hold off on that. But if you have a stock that's going up, but it's sort of doing its normal uptrend where it's having its higher highs and higher lows, or a sideways stock that's having similar highs and similar lows, then those are really good candidates for doing covered calls. If you were to sell the $19 call option, if you were to sell the $19 call option, what does that mean? Well, you are selling the right for someone to buy your stock at $19. You currently, the stock is going for $18.24. Now, remember, if we're using our technical analysis to potentially maximize our profits, you probably had already bought your stock at this point. So let's just scroll down. So you probably would have bought your stock when the stock was again uptrending, and then you saw 1, 2, 3 green arrows. So let's say that you bought that stock right on 3 green arrows, bouncing off support. So let's say that you bought that stock somewhere around $17. So you already own the stock. Now the stock has rallied in price, and so the average upside move from support is about $1.20. You can see currently it's at $18.24. Let's say that resistance is somewhere around $18.50. All right, so you can see it's already made a rally up or a move up. There's a chance that this stock, since it has made its average move up, there's a chance that this stock may hit a resistance area and start to roll over. If it starts to roll over, and let's say that the Koval indicator starts to roll over, the MACD starts to roll over, if it starts to roll over, that would be a really good time to sell a call off of this stock that you own. So let's say that that happens. Let's say technically that shows. So let's say that we look at selling the $19 call option. If we sell the $19 call option because we're the seller of the call, then we would collect. So if we're the seller, we'll take a look at the bid. If we're the seller, then we would collect, in this case, 55 cents for the bid. Could you go in between since it's a 10 cents wide spread between the bid and the ask? Certainly you can do that. If you just go for the bid, you would collect 55 cents or $55 per share. which would mean $55 for one contract, so 55 cents or $55 for one contract, for if you own at least 100 shares. If you own 1,000 shares of this stock, then you would actually collect $550 to sell 10 contracts of the $19 call option. So you can see how if you've been owning shares of stock all this time, whether it's an exchange traded fund or just an individual stock, you can see that you could have been selling a call option every single month on stock you own and making that additional income or that additional premium, and actually make a decent, reasonable rate of return every single month. So instead of owning stock and just wanting that stock to go higher, well, now you could own that stock, allow that stock to go higher, but at the same time collect a rate of return every single month by owning the stock anyway. So this is what skill does for you. This is what additional knowledge does for you, is it starts to allow your money, that money that you've worked really hard for, it starts to allow that money to start to work for you. Now, let's see what we need to see in order to make that premium. So again, stock is at $18.24. Let's say that you bought that stock originally on those 3 green arrows, uptrending stock, for $17. You sell the $19 call, all right, and you collect 55 cents or $55 for one contract, all right? Now, on expiration, let's say that the stock closes at $18.76 on expiration. Will someone exercise their right to buy your stock at $19 if on the open market it's currently going for $18.76? What do you think? They will not exercise their right to buy that stock at $19 because they can get it from someone else on the open market at a cheaper price, $18.76, which means no one will exercise their right to buy your stock at $19. That $19 call that you sold is not worth anything to anyone, which means on expiration, this $19 call becomes worthless, which means that 55 cents that you collected initially by being the seller is now worth 0 on expiration. Well, that's great news for you because that's what you want as a seller, is you want to be able to collect money and then let that decrease in value so that you can keep the money that you collected. You now keep that 55 cents per share. You no longer have that call option because it expired worthless. You still own the stock. You can now let the stock continue up higher. Once it hits a higher high and starts to roll over, you could then choose to sell another call the next month out. And then you could just keep on doing this every single month. And if you're never called out of your stock, then all you're doing is just renting out your stock, collecting additional income or cash flow just by owning the stock anyway that you've owned for years and years and years. All right? That's one scenario. Let's say the second scenario, let's say the stock does nothing, closes at $18.24 on expiration. Again, no one will exercise their right to buy your stock at $19. You keep the premium because that call option becomes worthless. You keep the premium and you still own the stock. You can sell a call the next month out. So let me get this straight. If my stock does nothing, I can still collect extra money or additional cash flow. Absolutely. Let's say that the stock on expiration actually closes above the call that you sell. So let's say the stock actually closes at $19.50. All right, now, will someone exercise their right to buy your stock at $19 if the stock on expiration is at $19.50? What do you think? You are right. Absolutely, they will exercise their right to buy your stock at $19 because they can get it from you at a cheaper price than on the open market at $19.50, which means they will exercise their right to buy your stock at $19. So you will essentially have to sell your stock at $19. Well, you had originally bought your stock at $17. So if you sell your stock at $19, you actually make profit here. You make $2 in profit just by selling your stock at a higher price, and you keep the premium that you collected initially of the 55 cents. So let me get this straight. You mean to tell me that I am actually having someone pay me money to buy my stock at a higher price? Is that right? I'm having someone pay me 55 cents per share to buy my stock $2 more than what I paid for it. That's exactly right. So it's actually not such a bad thing if you are called out. Because if you're called out, you keep the initial premium that you collected, plus you make money on your stock, and now you don't own the stock anymore. You now have cash instead. You also made additional cash flow from selling the call, and now you're in cash totally. You just can turn around and the next month maybe do another covered call trade, maybe buy another stock and sell another call. Or you could always re-enter the same stock and then sell a call. All right. So being called out is not a bad thing. And this is why we actually prefer, if we're going to sell a call option on the stock that we own, we would prefer to sell a higher strike. Why? Because then if we are called out, we actually make money on the stock itself, plus the premium that we collected by selling the call option. So that's another scenario. Now, let's say that you sell, so you originally bought the stock at 17, you sell the $19 call option, you collect 55 cents in this scenario, all right? And let's say the stock is currently at $18.24. Now, let's say that the stock actually starts to go down. So let's say it starts to go down to, it goes down to $18 and let's say 80 cents. Right, so it goes down to $18.80. So instead of going up, it now starts to go down to $17.80. So $17.80. All right. Well, that means that if the value of the stock goes up, of course, the value of the call option goes up. If the value of the stock goes down, the value of the call option also goes down. All right. So this value is not now starting to go down. So what's happening is that we want, as the seller, remember, we want the value of the call option to go down because then we can lock in more premium or buy to close at a cheaper price. So that means that this starting to decrease in value is offsetting what we're losing on the stock itself. All right. So this is actually helps to balance out or helps to minimize the temporary loss that we're seeing on the stock. Now, if we want to completely exit out of the stock because we think, you know what, I think the stock is really starting to show weakness, I'd like to go ahead and exit the stock entirely. Well, you just, if anytime you exit a trade, you just want to reverse what you did initially. So initially, if you bought the stock and then you sold the call and now you want to get out of this trade entirely or exit out of this trade entirely prior to expiration, you can always exit prior to expiration. You would just reverse what you did initially. So if you bought the stock and you sold the call, well, now you can buy back the call that you sold. So let's say at this point the stock is just worth 10 cents. You could buy back the call that you sold at 10 cents, right? So you sold to open right here. You can buy back the call that you sold to open. You can buy back the call that you sold at 10 cents and then turn around and sell the stock. All right, and then you're out of the trade entirely. So there are a lot of things that you can do. You're not always locked in until expiration. You can definitely make choices prior to expiration. So that is how a covered call works. All right. So when you're doing a covered call, if you're going to, let's say you already bought the stock, if you're selling the call, all you do is you select the strike price you want to sell. You would sell to open the call. Whatever premium that you would collect, you would specify what premium. All right. You don't want to, again, you don't want to do a market order because that's just giving the market a blank check. If you collect $1.20, that's $120 for one contract. And if you're doing 5 contracts, you can see how that's more than $500 that you would collect if you own 500 shares of stock, which is not bad at all. Day order, which means that if you don't get filled, don't chase the trade. You want to reassess to see, reassess that night after the market is closed to see if you still want to sell a call off of the stock that you own. All right. So that's up to you. And how do you monitor this? So again, if the stock stays below the strike that you sell, so again, if you had bought the stock at $17 and you sold the $19 call, all right, as long as the stock stays below 19 in this case, no one will call you out. All right, which means you just collect or keep that premium that you initially received when you sold the call option. All right, so that's really, as long as the stock stays below the call that you sell every single month, you won't ever be called out. You just collect that quote rent money every single month or additional income or cash flow on the stock that you own every single month. All right, so if the stock can still, as you know, as you can see, can still go up a little bit sideways, even if it goes down a little bit, as long as the trend doesn't change, then you're just collecting premium every single month on the stock that you own. Now, you can always buy to close the call that you sold or the short call prior to expiration. We've talked about that already. If you want to exit that call option prior to expiration. In other words, if you think there's a chance that you might get called out, you can always buy back that call to close and then lock in your profit. And then now you own the stock and you wouldn't be called out on your stock. And then, of course, you can utilize your technical analysis to be able to buy back that call option at a cheaper price and lock in that profit difference, collect the majority of the premium that you received when you sold the call initially. So if you're going to buy it back early, so initially, let's say that you sold to open at $1.20, all right, you can buy that call back. So that means you would buy to close the same call option. You would buy to close, but this time the call option is not worth as much. So in this case, it's worth about 55 cents. So you would collect the profit difference between $1.20 minus 55 cents. You would lock in that profit, and now you're out of the call side of the trade and you just own the stock. So now you're still collecting some additional premium, maybe not as much as the $1.20, but the difference in profit is still better than just owning the stock and not doing a covered call at all on your position. So that's what you're looking for if you were to buy back the call early. All right. So again, what are you doing when you do a covered call? Well, step one, you buy the stock or you already own the stock. Step two, you sell the call. We know that we can do it at separate times or leg in. We can buy the stock first and then sell the call. We know how to monitor the trade. All right. So we find that good stock, we then sell a call option. Oh, and by the way, if you're looking for potential covered call stocks to do your strategy on, you can look for different types of searches if you would like to. So one, you could do a good stock search, you could do almost good stock search, you could do an undervalued stock search, you could do an elite covered call search. Now, this elite covered call search that Mike has on the website, he actually offers you two options. He actually offers you an out of the money call, again, an out of the money call. Now remember, out of the money call options are made up of time value, which is even better for you because that means that that call option, that premium will decrease even faster because that time value is working in your favor. So an out of the money call option, so in this case, the stock is currently worth $38.82. So this would be an out of the money call option as a choice for yourself. He even offers an in the money call option. So 38.82 is the current stock price. 38.50 would be considered in the money. Now, if you ever decide to sell a lower strike, a lower call strike, or a lower call option, which would be an in the money call option, you just have to make sure that whatever you collect in premium for the in the money call option is more than what you would lose in the stock value itself. So that means from $38.82, 38.82 to 38.50, that's a decrease in the stock value, correct? So you want to make sure that whatever you collect in the premium by selling the call is actually more than what you would lose on the stock value itself if you were to be called out at $38.50. So that's something you want to look for. But some people, let's say that they happen to be in a downtrending stock, they might actually sell an in the money call option just to be able to make a bit more in the premium to help offset their loss, because you will collect a little higher premium, but that's because the value of the stock is lower. And so it's got to offset that somehow. At some point, you've got to ask yourself, is it worth it for me to own a downtrending stock? Yes, I might be able to offset some of my losses by selling an in the money call option, but bottom line, you have to ask yourself, is it worth it for me to even own a downtrending stock? Because I'm still losing money on the stock itself. It's just I'm trying to sort of offset some of those losses because I now have a bit more skill. So that's something you just have to decide, make that choice yourself. We mentioned that when you buy the stock first, you would prefer an uptrending stock because you would prefer the stock to go up in value. So when would you buy that stock? You could buy that stock off of 3 green arrows. Maybe it bounces off support. Maybe it breaks through resistance. When you sell the call, again, you'd rather sell the call when it's worth more money. So the best time to sell a call is when it actually hits a resistance area and starts to roll over. That's the best time to sell the call. And of course, you can always buy back that call when it maybe hits a support area. Buy that back, lock in not all of the profit, but the majority of the potential profit. What are some of the risks when you do a covered call? Well, number one, you might be assigned. What does that mean when you're assigned? Well, that means that you might have to sell the stock at the strike that you sold the call at. So that's what assignment means. If you do have to sell the stock, in other words, if someone exercises their right to buy the stock from you, which means that they make you sell the stock, then it will happen essentially overnight. It'll happen pretty much right away. And if you don't want to be called out, which is what basically is happening, if you don't want to be called out of your stock, then you can always choose ahead of time. If you really think there's a chance you might be called out, you can choose ahead of time to potentially buy back the call that you sold so that you won't be called out. And you can always be called out early. It doesn't always happen. It doesn't have to happen, but there's always that chance. And if you're called out early, then you essentially just sell that stock and you still keep the premium and you're now in cash and you move on to your next potential trade. The other thing about covered calls is that you can lose potential profits if the stock rallies. Now, this is really based a lot on your technical analysis. So I mentioned that the best time to sell the call is when it hits a resistance area and starts to roll over. If it goes to a high and you don't wait for confirmation that it really did hit a high and it really did establish a resistance area and is now starting to roll over, what if it then goes higher? So let's say that you thought this was the high, so you sold a call option for $1. Well, it turns out it really wasn't a resistance area and it just keeps on going up. Well, again, if the value of a stock goes up, the value of the call option goes up, which means now the value of the call is actually increasing in value. So now you're sort of leaving money on the table because you maybe sold the call maybe before it really did hit a resistance area. So that's what we mean by you lose potential profits if the stock rallies, because you could get called out. It doesn't mean you have to get called out, but you could get called out. And of course, downtrending stock, you really have to ask yourself, I could sell calls on a downtrending stock. If they're in the money calls, I have the potential to make a little bit of a higher premium, but I'm still losing money on the stock itself. That's something that you really have to ask yourself, how much longer do I really want to own a downtrending stock? Now, the advantages of doing a covered call is, of course, you can actually start to collect potential income or cash flow every single month, perhaps 1-2% per month, maybe even sometimes 3% per month. And that's a lot better than just buying a stock and you're not really sure what you're even making money on when you own that stock, or you own even a mutual fund. A mutual fund, you might be thinking, well, how am I actually making money? And for sure, a mutual fund, you can't rent out that mutual fund. But with a covered call, you can start making a decent rate of return every single month. Of course, it helps to offset some of the pullbacks that you might see in your stock, and you can use covered calls to start to grow your portfolio. So really nice advantages to doing a covered call. Now, of course, if the stock starts to change in trend, you can certainly exit out of that trade. If you're not assigned, then if the stock is just continuing nicely and you're not assigned, then you can just continue to collect money on that every single month. If you are assigned, then essentially you now have cash in your account from both the stock and from both selling the stock and collecting money on the short call. And now you move on to the next trade. And then, as we mentioned, early assignment is always possible. So with a covered call, you can buy stock or you already own stock, and then you can, quote, rent out that stock by collecting some extra premium when you sell a call option off of stock that you own anyway. If you're looking to buy stock, you can even first have someone pay you money to potentially buy the stock at a cheaper price than what you would have bought it anyway. That was called selling a put. That's what we started out the session with. So there are a lot of choices with options, and what's exciting is that you are now gaining some additional knowledge, which is going to give you additional skill. And anytime you have additional skill, you can really start to have your hard-earned money, you can really start to have that money work for you. So with that said, we're going to go ahead and wrap this session up, and we will see you in the next lesson. Thank you, everyone.